Welcome to TalkTickers. You're here for the essential insights from the latest earnings calls, delivered straight to the point.
That's right.
Today, we're diving into a recent call, and wow, there was quite a bit going on. Significant growth, some strategic shifts.
Indeed. Q1 2025, it really painted a picture of strong momentum, especially in the core business.
Okay, let's jump right into those key numbers then. Total revenue hit $1.5 billion.
Which is a pretty hefty jump, right? 40% year over year.
Yeah, 40%. And the bottom line looked even better, actually. Adjusted EBITDA soared 83% to hit $1 billion.
And that translates to a 68% adjusted EBITDA margin. Very, very strong.
Right, 68%. And just for context for you listening, an 81% adjusted EBIT margin in their advertising segment specifically, that's exceptional in this space. Way higher than you often see. Suggests, a real edge.
Absolutely. And that profitability, it wasn't just EBITDA. The EBIT margin grew too, expanded by 600 basis points compared to just the previous quarter.
That kind of improvement, that's often what we call strong operating leverage, isn't it?
Exactly. As revenue grows, profits grow faster because those fixed costs get spread out more. It's a good sign.
And the cash flow also looked really healthy.
Oh, definitely. Free cash flow reached $826 million. That's more than double last year.
And up 19% just from Q4. What really caught my eye, though, was the conversion.
The 82% flow through, yeah.
Exactly. 82% of that adjusted EBITDA turning straight into free cash. Speaks volumes about how capital efficient the model is.
Investors love seeing that high conversion rate. And they put that cash to work too. They repurchased and withheld shares.
Right. About $3.4 million shares, costing them $1.2 billion, mostly funded by that free cash flow.
Which brought the outstanding share count down to 338 million, net of what goes to employees.
So not just growing the top line, but actively trying to boost shareholder value through buybacks. Okay, let's pivot to the engine here. Advertising.
Yeah, that's clearly the main story. Ad segment pulled in $1.16 billion in revenue.
And $943 million in adjusted EBITDA. That gives you that 81% margin we mentioned.
Which is, again, just remarkable. And the sequential flow through, how much new revenue turned into profit, it was actually over 100%.
104% or 100% if you adjust for some one-offs. EBITDA, by the way, is, similar to EBITDA, just slight differences sometimes. Key point is super profitable.
Extremely efficient. And speaking of focus, they announced they're selling the games business.
Right. To Tripledot Studios. $400 million in cash. Plus, they keep a 20% stake in the combined company. Expected to close pretty soon in Q2.
That's a very clear signal, isn't it? Doubling down entirely on the high margin advertising side.
And the Q2 guidance reflects that. For advertising, they're projecting revenue between, $1.095 billion and $1.215 billion.
And adjusted EBITDA between $970 million and $990 million. Still targeting that 81% margin. Consistent.
Okay, so strong numbers headline it. But let's dig a bit deeper now into what's actually driving that ad business growth.
Well, the call really emphasized improvements in their machine learning, the Axon platform. That plus getting a full quarter's contribution from web advertisers.
That Axon platform seems absolutely central. And it's kind of funny, right? That tech was originally built for the games business they're now selling.
Yeah, it highlights that internal synergy, even as they strategically separate. The tech found its best home in advertising.
And selling games isn't just tidying up. It feels very deliberate, freeing up resources, management focus, everything for ads.
Precisely. Management laid out 3 key priorities for ads in 2025. First, just keep relentlessly improving those ML models using the latest AI stuff.
Okay, makes sense.
Second, keep pushing on e-commerce and web advertising solutions, refining the models for web specifically.
Right, and they mentioned better integrations with third-party platforms and attribution vendors. That sounds critical for the web.
Definitely more complex than in-app. And crucially, they're launching a self-service dashboard this quarter, initially for select customers.
The opportunity they see in web is, massive. They said current penetration is less than 101% of the total market.
Yeah, tiny. So that self-service dashboard, it's clearly positioned as the key to unlock that growth. Automate onboarding, campaign management.
Right. And the third priority, using generative AI for ad creation.
Yep. Enhancing ad testing, automating ad creation. The goal is better campaign performance, higher response rates for advertisers, by making ads more, dynamic and personalized.
Leveraging that huge user base, over 1 billion daily actives to create better ads. Makes sense.
It's all about delivering better ROI for their clients. Better ads, better results.
Now, tariffs always come up with global tech. What was the take there?
They don't expect a significant direct hit, Over 90% of their ad revenue is mobile games.
Okay.
And their web focus right now is mid-market advertisers, not really the big Chinese e-commerce players affected by those de minimis tariff changes, the import duty thresholds.
So it sounds like they're somewhat insulated from current trade stuff strategically.
It appears so. Their focus helps there. They also talked about competition.
Yeah, seemed pretty confident. Said they welcome it, banking on their data advantage, their AI expertise, that data moat idea.
Right. They believe their tech gives them a strong edge that's hard to replicate. And interestingly, they see potential changes in App Store payments as a positive.
How so?
Well, the thinking is if developers, their customers pay lower fees to Apple or Google, they might have more budget left over for user acquisition.
Ah, and that extra budget would likely flow to the most effective ad platform.
Exactly. Which they believe they are, especially for games, so it could actually boost their business.
Got it. Okay, one number that jumped out at me was the efficiency metric run rate adjusted EBIT per employee in advertising.
Oh yeah, roughly $4 million annually per employee.
That's incredibly high, suggests a very lean, very productive operation.
It really does. Underscores the efficiency.
Now, they did address the Q2 guidance, which implies maybe slower sequential growth in Q1.
They did. They attributed it mostly to typical seasonality. Q2 is generally slower after the Q1 holiday boost.
But they also emphasized, potential upside from the models improving and that self-service dashboard launching soon.
Right. And they were keen to point out this isn't like, say, 2022 when they saw slowdowns. They argued the Axon model is much more advanced now, so past trends aren't necessarily predictive.
Okay. What about expanding into new web categories beyond fintech, healthcare, insurance?
Current priority seems to be onboarding the existing pipeline first and really nailing the self-service tools. They admitted the web model is still early days, but actually performing better than they expected internally.
The long-term goal is pretty ambitious, though. Reach the same kind of dominance in web as they have in gaming ads.
Huge potential if they can pull it off.
And that generative AI for ad creation, it's all about using their scale, that billion-plus users, to make ads much more tailored, right? Drive better responses.
Yeah, it's a key innovation area. Makes creating effective ads easier, potentially attracting a wider range of clients who maybe couldn't do that kind of creative work themselves.
What about churn? Are web advertisers sticking around?
For the bigger ones, spending around $250K a year run rate, churn is low sub 3%, which is good.
But not zero.
Right. Their goal is to get it down towards the near zero churn they see in the gaming side as the web product matures and proves itself more. Shows the aspiration.
Okay, let's talk metrics. That 49% year-on-year growth in net revenue per install, that's mostly reflecting the gaming side, right? The CPI advertisers?
Primarily, yes. Cost per install. It doesn't directly capture, say, a purchase driven by an e-commerce ad, an action, although
the revenue from those web advertisers does contribute to the overall net revenue figure, even if the install volume stays flat.
Exactly. So web revenue is helping drive that metric up, even if the denominator installs isn't growing much from that segment. It's a blended figure.
And performance for web advertisers, they acknowledged it varies.
Understandably, yeah. The web models are just newer than the gaming ones, which have been refined over years. The goal is absolutely to get the web models just as good, just as predictive over time.
Requires ongoing learning, tweaking the algorithms.
Constant optimization.
What about features like excluding audiences? Some advertisers want that.
True, but their focus for now, especially with web being early, is just nailing the core matching, getting the right ad to the right user to hit the advertiser's ROI goals at scale.
So foundational stuff first, fancy features later.
Pretty much. Priority is making the core engine work exceptionally well before adding bells and whistles, particularly for the newer web product.
They did mention the pace of adding new web advertisers had slowed a bit.
Yeah, attributed it to team resource limits, which brings us back to
the self-service dashboard. That's meant to fix the bottleneck, automate onboarding, and let them ramp up new customer acquisition faster.
Exactly. Critical for scaling web without just hiring tons more people.
How does the current web product handle different purchase cycles?
Seems what works best right now for advertisers with shorter conversion windows, maybe 24 hours or so. That's partly due to tracking limitations like cookie windows.
So optimizing for, say, a car purchase or something with a long consideration period isn't the main focus yet.
Not the primary focus, no. They seem to be targeting the much larger market where conversions happen faster, where their current tech is most effective. Maybe optimizing for earlier funnel actions, like a call or email signup, for those longer cycle products could be a path later.
But first things first, capture the quick conversion market and the self-service rollout itself. How's that happening?
Phased approach. Start with current customers, get feedback, then expand to all current ones, then open it up to new clients in stages.
Makes sense. Ensure quality, stability before opening the floodgates globally.
Right. They also expect that dashboard, by bringing in more diverse advertisers, will generate more data.
Which feeds back into the models, improving them over time. A virtuous cycle.
Hopefully, yeah. More data, better algorithms, better results.
Okay, shifting gears slightly. That mention of potentially acquiring TikTok's non-China operations felt a bit like a moonshot, but...
Definitely acknowledged as a long shot. But you can see the appeal, right? Combining their AI ad tech with that massive user base, the potential economic value is, well, immense.
Transformative, if it ever happened. Okay, back to their own organic growth. The long-term target is still 20-30%.
That remains the target. They broke it down interestingly.
How so?
They see ongoing reinforcement learning in the models, adding maybe 3-5% growth quarterly, just continuous improvement.
Okay, incremental gains.
Plus bigger step function increases from specific directed model enhancements. Historically, those have added maybe 10% annually. They expect at least one big one per year.
So a mix of steady tuning and bigger breakthroughs. And priorities for this year driving future growth.
Non-gaming app-to-app user acquisition is one area, and continuing to develop those dynamic, personalized ad creatives using AI.
Both seem like natural extensions. They expect non-gaming to be, what, over 10% of ad revenue this year?
Yeah, more than 10%, with significant growth expected once self-service really gets going for that segment too.
And the models for gaming and e-commerce learn separately.
Yes, which is interesting. Allows for independent breakthroughs. They noted e-commerce is much earlier stage. Gaming has had multiple big iterations already.
Explains the performance difference currently, but also shows the runway for e-commerce improvement.
Exactly. Lots of potential there still.
So that strong Q1 sequential growth probably had a mix of model improvements and the full quarter of e-commerce, but mostly still gaming driving it.
Seems like the breakdown, yes. And they still see room to improve conversion rates even within gaming.
And just to confirm, the Q2 guidance doesn't assume any benefit from the game studio spend sticking around.
Correct. Divestiture expected near quarter end, impact not seen as material for Q2 guidance anyway. It's all about the core ad business outlook.
Okay. And the App Store fee discussion, potential fee relief, could be a real tailwind.
Potentially significant, especially for mobile game developers. Lower fees mean more UA budget.
User acquisition budget.
Right. And as the biggest channel for mobile games, they'd likely capture a disproportionate share of that increased spend. Their auction dynamic would likely see bids rise. Good for the ecosystem, good for them.
So their whole model of monetizing a fairly stable user base just hinges on getting better and better at matching ads.
Fundamentally, yes. Strengthening the algorithms, the tech. They expect the transaction rate, the number of ads shown and clicked, to increase over time with more advertiser demand and better creative personalization.
And the gaming market itself still looks solid.
They see it as robust, diverse, not overly dependent on single hits, not hugely impacted by tariffs, free-to-play seen as pretty resilient even if the economy slows.
Provides a stable foundation. One last thing, self-attribution on web.
Right. They built the web product aiming for self-attribution. Acknowledge the cookie window limits, but feel it works well for quick conversions.
But they are working on third-party integrations too.
Yes. Actively working on integrating with third-party attribution providers for web. Give advertisers more measurement options, build that confidence needed to become a primary channel for them.
Makes sense. Address the current limits while building towards a more robust future state. Okay.
Precisely.
All right, let's transition. Time for our This Is Not Financial Advice segment. We take what we've heard, spin out some, let's call them creative ideas.
Okay, creative is good. So building on that AI advertising growth theme and the sheer processing power needed. How about this? Maybe look at companies providing advanced thermal management for data centers.
Cooling systems.
Exactly. As these AI models get bigger, hungrier, they generate immense heat. Cooling becomes absolutely critical. Efficient, innovative cooling tech could be in high demand, sort of irrespective of which specific ad platform wins out.
A picks and shovels play on the AI infrastructure needs. I like it. It's definitely thinking outside the box a bit.
It's a fundamental need driven by the trend.
Okay, interesting idea. Well, that wraps up our deep dive for today. We've unpacked the financials, the big strategic shift to advertising, the AI focus, that upcoming self-service platform. Lots to digest.
Definitely. The focus on AI performance marketing and the web expansion are key themes.
So what do you think? How big is the web opportunity really? Will that self-service platform be the game changer they expect? We'd love to hear your take. Join the conversation. Let us know what stood out.
And as always,
remember, this is absolutely not financial advice, just our perspective on the information discussed today.